So there are several different types of mutual funds. They have different investment policies. Here you can see on this slide that the funds are categorized based on the types of securities they hold. So money market funds, as the name suggests, these funds hold money market securities like commercial paper, treasury bills, CDs, and things like that. And one important thing about money market funds, we have talked about this actually earlier in the course, is that the price of money market funds is fixed at $1 per share, right? The price is not allowed to fluctuate because these assets are so safe, they are almost risk free. So the price is able to or price is it is possible to keep the price at $1 per share, and it is not allowed to fluctuate. Again, if you go to this Vanguard website and look for mutual fund listings, you can see several different types of money market funds here, and you can see the price here in this column. Price, basically the net asset value. For all these money market funds, the net asset value is $1, right? So these hold money market securities. Then of course you have equity or stock funds. Again, these predominantly invest in stocks. They might have some cash or fixed income, but a vast majority of the investment is in stocks, and they come in several different varieties. They might be categorized based on size. So small cap, mid cap, and large cap funds. So they hold small, mid cap, or large size companies. Then you might have categorization based on growth and value. You might have some income based funds like dividend income funds and so on. So several different types of funds holding different types of securities. Um, then you have sector funds or industry funds. So again, pretty evident here. These funds hold securities in a particular industry. Again, you can look at some examples here of the offerings from Vanguard. So these are some of the sector funds that Vanguard has. So you have energy, you have healthcare, you have real estate, right? And of course, at other places for other investment companies, you can find sector funds from many different sectors. So they hold the securities in that particular sector. So if an investor is looking for exposure to one particular sector, they can consider investing in this sector funds. Then you have fixed income or bond funds. So again, a large variety of bond funds are available. You have categorization based on the issuer. So you have tax exempt funds, which are municipal bond funds. You have treasury funds. You have corporate bond funds. So you can see the tax exempt category here. Investment grade, or this is below investment grade actually, so that is like the junk bonds or high yield bonds. Then you have the investment grade corporate bonds, you have the treasuries, right? So these are the US government bonds. So different types of bonds with different degrees of riskiness and different maturities are available for investors to invest in for their fixed income allocation. Then you have international funds. Again, very wide variety of international funds are available these days. You can get exposure to sort of the entire world through mutual funds. So there are global funds that invest pretty much in all major markets around the world, including US. So if you're looking for a single portfolio that invests everywhere around the world, including US, you can go for a global fund. If you already have some investments in US domestic securities, and now you're getting to, or now you're looking to get some international exposure, then you can invest in international funds. So international funds are funds that invest in securities outside of US. So in this category, you can of course find sort of broad diversified fund that invests in most markets around the world outside US, or you can also pick regional funds which can be so you can have like a fund that invests in European securities or Asia Pacific, or even individual countries like a Brazil fund or a Japan fund and things like that, right? And then emerging market fund. So again, this is a specific type of fund that I would invest in emerging markets, BRIC countries, Brazil, China, India, and so on, right? So those are all considered emerging markets, and you can get exposure to those markets in your investment portfolio. So there are broad variety of funds that are available to investors, pretty much catering to all different investment needs. Then you have balance funds. So balance funds invests in both stocks and bonds, and life cycle funds or target date funds are good examples of these balance funds. So I've talked about target date funds earlier in the course. Again, you can see some examples of these funds on Vanguard website. So you can see these are the target retirement funds. So if let's say there is an investor looking to retire in 2050, that investor can simply choose a target retirement 2050 fund. This would be a balanced fund made up of stocks and bonds. Since this is retirement that is 30 years out, it would basically be predominantly invested in stocks today and a relatively small allocation to bonds, and over time it would get more conservative and shift allocation to bonds. If you look at a target retirement 2020 fund, that is for an investor looking to retire this year, that of course would be more conservative, much more conservative. Might have only 25% or so in stocks, but 75% in bonds, right? So these are examples of balanced funds holding both stocks and bonds, and they've become very popular over the years because investors don't have to worry about rebalancing over time. They can just choose a single portfolio that meets their allocation needs. Okay, and then you have funds of funds. So these are basically what these various target retirement funds are. They are basically funds of funds. They take other Vanguard funds and then they invest in different Vanguard funds. Some are stock funds, others are bond funds, and so on. Okay, and again, these are very popular. So I'm again using Vanguard as an example, but you can find similar type of funds at Fidelity or other large major investment companies. Then you have asset allocation funds. So these are also a combination of stocks and bonds, but they are basically geared towards market timing. So if the fund manager believes that, let's say, next month the stocks are going to do better than bonds, then these funds are predominantly going to invest in stocks, basically shift the allocation to stocks. If the stocks are expected to perform poorly, then the fund manager can choose to disproportionately allocate to bonds. So the goal is to try to time the market, and so therefore they are actively managed. All right, so these are asset allocation funds. And then finally we have index funds. So we have talked about index funds in our market efficiency discussion, active versus passive, right? Index funds are passive investment vehicles. They track specific indexes like the S&P 500 index, for example. So there is no effort to beat the market. The goal is to try to mimic the performance of the index that they are tracking. And over years, these index funds have become extremely popular, and because they do not require any research to pick securities, they do not require any resources for analysis and things like that. They're actually quite cheap, much cheaper than actively managed funds, right? So they have become very popular. They are relatively inexpensive. All right, so these are the various types of mutual funds that are available to investors, broadly speaking. All right, one of the most important things that the investor should pay attention to when investing in mutual funds is the fee structure. As a mutual fund investor, you might be liable for different types of fees. And fees are very clearly stipulated for all funds in what is known as a prospectus. Most fund companies also provide the fee structure on their websites. Um, if you have, like, say, a 401k which offers like mutual funds, which mostly 401ks do, then it is very important to look at the fee structure to be aware of what you're actually going to end up paying for investing in a particular fund. Okay, so there are different types of fees that a fund might have. You have operating expenses, which is commonly listed as an expense ratio. You might have loads, front end load or back end load, and then there are some other charges like 12b1 charges. So we'll talk about each one of these one by one. So operating expenses, these are expenses to cover the operations of the fund. So pretty much all funds out there are going to have some operating expense, and therefore you will have to pay this fee to pretty much all funds out there. However, the fee varies greatly. You have, for example, index funds that might end up charging a very small amount. Like if you, let's say, look at an S&P 500 index fund. So let me see if I can find that here. S&P 500 index fund. Yeah, so that's 500 index shares here. The fee structure is here, right? So you can see here for this particular fund, which is basically S&P 500 index fund, the expense ratio, which is again the same thing as operating expenses, it's 0.04%, right? So every year you're paying 0.04% of the total assets that you have in this fund as fee, right? So that's pretty low. It's pretty inexpensive. On the other hand, you might have actively managed funds which might charge 1 to 2% operating expense, so they are much more expensive than index funds. So index funds have relatively low operating expenses. Fidelity actually has a couple of funds with zero operating expenses even, which are available to investors now. So as the competition has increased in this space, the fees have actually gone down to the benefit of investors. Then other types of fees that may or may not be there. Sometimes you have a front end load, which is basically an entry fee. So at the time of purchasing the shares in the fund, you might be charged a one-time fee, which is known as the front end load. Again, quoted as a percentage. So if you have like a 3% front end load, then whatever you're investing in the fund, 3% upfront would be deducted from that as a fee. So this is a one-time charge, unlike the expense ratio, which is a recurring annual charge, right? So 0.04% that we saw, that is per year. Okay, this is a front end load is a one-time charge at the time of purchasing the shares in a mutual fund, and it may or it may not be there. A back end load is the exit fee, right? So that is at the time of selling the shares of the fund, you might see a back end load. So again, if you look at, for example, this fund here, all the fees are clearly stipulated, like I mentioned before. So you have this operating expense, 0.04%, but other types of fees. So purchase fee, which is our front end load, that is zero. Back end load is the redemption fee, so that is also non-existent here. So this particular fund does not charge any front end or back end load, but that may not be true for other funds. And then you have the 12b1 charges. So this name 12b1 actually comes from SEC regulation rule 12b1 that allows mutual funds to charge these fees to investors. This is for covering their marketing and distribution costs, paying to the brokers and financial advisors and so on. So this is also like quoted as a percentage, and like the expense ratio, this 12b1 is also an annual recurring charge, and again funds are required to disclose if they have a 12b1 fee. And as you can see, for this particular fund there is no 12b1 fee, right? So for this fund here, the only fee that the investors would be responsible for is basically this expense ratio of 0.04%. But again, that may not be true for all the funds that you come across, right? So it is very important to pay attention to this fees, because fees obviously can impact your long-term performance. So there has been some research on the impact of fees on performance, and what has been found is that generally speaking, funds that have higher fees, higher expenses, they tend to have inferior performance. So you obviously want to avoid those funds with higher expenses. Okay. Now, want to illustrate the impact of fees on performance using an example here. Sometimes funds offer different classes of shares. Like you can see here on this slide, three different classes of fund shares, A, B, C. The fund is the same. It's the same underlying portfolio of securities. What these three classes differ in is their fee structure. So for example, class A shares of that fund might have a high front end load, but class B and C do not have any front end load. Class A might have high front end load, but then if you see their expense ratio and their 12b1 fees are relatively smaller. Class B, even though they don't have a front end load, they do have a relatively higher expense ratio and 12b1 fees. So recurring charges are higher here, one-time fees are non-existent. Here for class A, there might be a one-time fee, but your recurring charges are lower. So if you have these choices available, then which one to pick would depend on your investment horizon. So for example, if you want to invest in the fund for very long term, you might be okay with paying a one-time high fees, this front end load, in exchange for lower recurring charges over time. However, if you're investing for the short term, you might want to avoid that high front end load, and you might be okay with paying a higher recurring charge, right? So it depends on how long you want to stay invested in that fund. And of course, the best bet is to just go with no load funds with a relatively low expense ratio, right? So that would be ideal. But how do you compute your return from mutual fund investment? Well, just like you compute your return from any other investment, right? Mutual fund shares use net asset value, right? So that's the share price. So you buy at a certain price, and let's say later on you sell at a different price, then what would be your rate of return? Well, selling price, this is NAV1 minus buying price, right? So price at which you sell minus price at which you buy, plus any income that you receive from the fund. This could be dividend or it could be interest income. And you might have capital gains distribution also as part of your income, right? So capital gains distributions are basically that if the funds sell the securities at a gain, then any capital gains are passed on to the fund investors, right? So that also becomes part of your income stream. So ending price minus beginning price plus all sources of income divided by beginning price, right? So that is just your standard return calculation. This is of course before fees, right? So this does not actually account for the fees. So NAV selling price minus buying price plus any income and distributions divided by buying price. So here is the example that illustrates the impact of fees on performance. So in this example, you have three different funds. Again, these are actually similar funds. Before fees, their performance is identical. Gross return of all funds is 12% per year. And so any difference that you see in what they differ in is their fee structure. So you can see the details here in the notes at the bottom. Fund A is a no load fund with 0.5% expense ratio. So this is the cheapest option of all. Fund B is also a no load fund, but its expense ratio is 1.5%. So that is 3 times as much as Fund A. And fund C has an 8% front end load, so 8% load on purchases. So you pay one time 8% fee to buy into that fund, and then on an ongoing basis you're paying 1% expense ratio, right? So you start with $10,000 invested in each of the three funds, right? And you will notice here that for fund C, because there is this 8% front end load, 8% is actually deducted upfront, so $800 is deducted upfront, and only 9,200 is actually invested in the fund. And then what we are looking at is, after accounting for fees, how your $10,000 is actually growing over time, right? So if you look at, say, after 20 years, you have basically about 15,000 more in fund A versus B or C, right? So that's actually a big difference for a $10,000 initial investment, and that is all driven by the difference in fees. Uh, in comparing B and C, what you will notice is that again B has a higher expense ratio versus C, 1.5% versus 1%, but C has a front end load. So even at the 15-year mark, B is actually ahead of C, right? So that one upfront 8% that you're paying, even after 15 years, despite the lower recurring expense ratio, you have not recovered that, right? It's only after 20 years that you see that C is actually ahead of B. So again, it depends on your investment horizon. The longer the investment horizon, you might be okay with paying that one-time front-end load, for example, here. But obviously, A is the best choice among the three. So you would want to look for funds that do not charge any load and generally have lower expense ratios and other types of fees.